Good morning, Mike Brady, Generosity Wealth Management, talking to you from Boulder, Colorado. And today I want to talk about diversification, dilution, how much diversification is good, how much is a waste, just kind of what my thoughts are around that. Because every once in a while I'm asked the question, Mike, how much is just really diluting the returns? And I've heard that so many stocks or sectors or mutual funds or something, it just really just waters everything down and you don't get ahead. Okay, I've heard that before, and my answer to that, and by the way, I only hear that when the market is going up, because but I never hear it when the market goes down. I mean, people like being diversified when the markets are going down, because chances are, I'm generalizing here, that the decline is not as much as if you were in one individual stock or one individual sector. And so really, you have to look at both. The market does three things: up, down, sideways. That's it. Okay, there's no rocket science around that. It goes up, down, or sideways. And yeah, in a upward market, you wish that in hindsight you were in this particular hot stock or this particular hot sector. But unfortunately, that's hindsight, and you have to acknowledge that we don't know what the future holds, but what we are doing is analysis of what we think might be in the future and weight things accordingly, understanding that, well, gosh, maybe I might be wrong. And so diversification, I'm not an individual stock picker. I've never recommended an individual stock to a client in my entire 21 years, because I'm of the belief that I want to decide on a sector. And a sector in my mind is not necessarily, biotechnology or something very specific, although that's also a sector. But what I'm talking about right here is large cap, small cap, middle cap, mid cap, value or growth, U.S., international. These are the types of sectors that I'm looking at. And it also can be subsectors, as I mentioned earlier, about biotechnology or healthcare or automotives or consumer discretionary, etc. But either way, it's really through analysis of what you feel that sector is looking at, because when we go a layer deeper to the individual stocks, there can be 4 out of 5 companies, let's say, that are doing well in that sector and one that's not. Are you going to be good enough to choose, not choose in this case, that one that has done really poorly? And so I think that that's a very difficult thing to do. And so that's one of the reasons why I believe that sector, or even which kind of category of stock or bond, depending on the client, is the better place to be. From a diversification point of view, most studies have shown that once you get over 20, you're not getting increased value for having that 21st stock, or if you have 40, you're not twice as diversified as if you just have 20. That's what many studies have shown. My experience and kind of my approach is, once I choose a kind of a broad sector, whether it's large cap, small cap, mid cap, etc., I usually have 1 to 2 positions within there, a lot of times an index within those particular sectors. And the index itself, of course, is usually dozens, if not hundreds of stocks, but I'm buying the particular sector or that particular category, whether it's growth or value or large or small, etc. Okay, so I don't believe that, dilution is really only when somebody wants to start hitting some home runs. I think the diversification is a better approach in the 3 types of markets that I've described, both up, down, and sideways. I do believe more in a kind of a sector approach to it, if you haven't gotten that already from this video, for goodness sakes. How much is too much, how much is too little? There's no right answer to that. It's something that I talk about with each client, and I'd love to talk with you as well. 303-747-6455. Mike Brady. Got a couple of disclosures here coming up, so stay tuned for that. And you have a wonderful week. We'll talk to you later. Bye-bye.